Hi, I'm Andrew Yomolkowski, founder and owner of Heartland Credit. Nice to talk to you again. Today, we're going to talk about credit cards. We're going to put it all together, so please pay attention. You know, credit cards can be a scary thing. When we first get them, we get excited about them, we use them, we start buying things that maybe we can't afford, but we want. And the next thing we know, we start paying a little itty bitty amount of interest every month, and sometimes it can feel like we're getting nowhere. I've been there before, I can relate. Well, credit cards are also an incredibly important tool to have great credit long term. So over the next several minutes, I'm going to do my best to explain to you how to drive your credit to keep it on the road instead of in the ditch using credit cards. So here we go. One of the reasons credit cards are so important is how the algorithm computes the actual physical data and turns it into the three little numbers called your credit score. Now keep in mind, to our video series, the three big ones we tend to focus on are 35%, which is pay history. So as you have a credit card, if you have a balance, they will report whether or not you made that payment on time. If your payment's due on the 1st and you don't get that payment in until the 1st of the next month, you just went 30 days late, bang, your credit score drops significantly, okay? That would be an example where having a credit card wouldn't be that good of a thing, all right? Now, second area that we talk about, pay history is 35%, is balance to limit relationship. This is only going to apply to revolving accounts or credit cards, okay? Balance to limit is 30% of your cumulative credit score. So what happens is if you have a credit card, first thing it looks at is, did they make their payment on time? Well, 35% of your score is, did you make it on time? But 30% of it is, how much debt do you have in comparison to that limit? So let's give you an example. Your limit is $10,000. Right now, you're at zero. You're optimum, okay? There is no difference between 0 and 29.99% of your limit. So basically, here's what I'm saying. If you have a $10,000 limit and you're carrying, whether it's a $2 balance or a $2,900 balance, you're really not negatively affecting your credit score, okay? Here's where it jumps in though. You go from 29,999, so 29.99% of the balance versus the limit, to 31%. As soon as you cross over that 30%, that 1% makes a big difference. Instantly, bang. The next time the algorithm computes your score, it's going to drop your credit score because you're over a threshold. Basically, the system's saying, hey, why are you living on credit card debt? If you only bought what you knew you could afford, you would probably pay it off in full. Now, here's examples where that isn't true. Maybe you went on a vacation. You went down to Jamaica and you bought a bunch of trinkets and fun things and stayed at a hotel and booked a helicopter ride and a booze cruise along the way, whatever. When you come back, if you have your credit pulled, if you've moved your balances over 30% of that limit, you're going to see your score drop, okay? Now, this is really easy to fix. All that you really need to do, folks, is keep your balances below 30% of whatever your limit is. So you have a $1,000 limit, keep your balances below $300. You have a $5,000 limit, well, keep your balances below 30% of your limit. Same thing if you have that credit card. I use the 10,000 because it's easy math, okay? You don't want that balance to get more. There's been lots of clients that'll call in, they're a 632 credit score, the banker just told them they need a 640, and all they need to do is bring their balances down on 2 credit cards, pay them off, let the data actually move all the way back through the credit bureaus, go back into the banker and have them pull your credit again. Chances are you're going to have moved from a 632 well over to what you need because the only reason your credit had dropped was the balance was too high to begin with. So again, 35% of your credit score is going to be pay history. 30% of your credit score is simply looking at what do you have for credit card, revolving debt, and what is the balance versus the limit. Keep that below 30% whenever you're going to have your credit pulled. I'll give you an example with myself. I travel quite a bit. I run the corporation, so I have a couple corporate credit cards. Well, in December, if I were to go in and buy a new company car, I would want to make sure that I probably in November looked at all my balances, and decided to not really buy anything in December so that I wouldn't have new debt on that card, so I could pay the card down to make sure those cards were below 30%, so that when I go in the last couple days of the year, they give me the best interest rate possible, because at that moment my credit looks as sparkling as it can be. I kind of call those optimum days for credit pulls, meaning you know you're going to go have something financed, you know that your credit's going to be used to determine the risk or the interest rate, so you're going to backtrack a little bit and allow those balances to come down maybe a month or two before, so that when you go in, you get the best deal you possibly can for the money. It always amazes me. People go into a car dealer, they'll spend 4 hours beating up the salesman and the car manager, and then they'll go into the finance offer and give it all back by giving a higher interest rate than they should by just understanding balance to limit, okay? Now, the third area where credit cards are so important is 15%. That's length of history. What happens, and why credit cards are probably the most important tool for you to build your credit toolbox long term, is that you can have them forever. Think about it. Your house, you're probably going to buy, sell 3 or 4 in the next handful of years. You're going to refi it a couple times, all right? A car, you're going to have a car, maybe a 3-year loan, maybe you'll trade it in after 2 years. Maybe you'll do a 5-year loan, you'll trade it in after 3. The point is the time frame that those accounts are physically reporting and doing positive work to your credit report is somewhat limited. Now let's look at a credit card. A credit card, you can apply, you can not use it for 3 months, then you can decide to have one thing purchased. You get a balance, you pay it off in full, you pay it off on time. Let's say you go another 3 or 4 months without using it on any level, and then it's Christmas time. So you buy mom a present, you buy dad a present, you buy one of the kids a present, use the credit card, and you pay it off in full in January. The beautiful thing about credit cards, first of all, if you don't have a balance, you don't make a payment. Second of all, 15% of your cumulative score is how long you have those trade lines on your credit. So by having a credit card, the key to the credit card is the date of which you were opened. Once you open a credit card, you want to keep that thing open forever. When I look at my credit profile, I actually have one credit card that I got right out of college. If I close that card today, which my credit score is near 800, it would drop me probably somewhere in the neighborhood of 50 and 100 points, because the one card that I've had for more than 10 years would be gone. So again, credit cards are vitally important. If we're telling you to get a credit card, it's because we want you to engage in credit. Think about it like this. Most of us went to school, okay, whether it be some type of middle school or high school, and we were graded. You remember what it was? As a 4 was an A, and a 3 was a B, and a C was 2, and a D was 1, and an F got a 0. And then they took however many classes we took, they added up those numbers and divided, and that became our GPA, our grade point average. Well, grades are based on performance. Well, you didn't have one class all 4 years of high school. You had maybe one for a semester, then a new class every semester, then another class the next semester. What we're trying to do is basically get you to take a class, okay? When you enter and engage with a credit card, you're taking a class that is going to be graded based off of how you perform. Do you pay it on time every month if you have a balance? Do you keep your balances below 30% where they're optimum? And then thirdly, do you keep them open for a long amount of time? Are you loyal to the company that you're working with? The reality is you want to be, because every month that you keep your credit cards open, once you get your credit cards 5 years from the day you've opened them, they're going to tremendously build and benefit your credit report. When I look at folks that have 800 credit score, typically the key to an 800 credit score is having 2 trade lines minimum that you've had open for 10 years. Now, I doubt you're going to want to do a 10-year car loan. I don't know that you're even going to want to do a mortgage and stay in one home for every 10 years. But credit cards, you easily can keep for 10 years if you're just loyal. So again, you're probably being told to get to a credit card at our corporate website, which is www.hcrepair.com. We have a credit cards tab. I personally shop credit cards for you. One thing I ask you to do, take a look, see which card fits you the best. Sometimes you maybe have to start with a secured card, meaning that you're going to give them a little bit of money up front. They're going to give you back an available credit line, but it's going to be for basically the amount you've already given them. So if you don't make their payment, they basically got their money anyway. Or you're going to work with a secured card for 3 to 6 months, show that you're demonstrating performance, show that you're going to do your homework, show that you're going to be responsible. The next thing you know, you're going to start getting the big dogs. You'll get Citi and Chase, the big 5 that'll start sending you credit card applications, and those will be the cards that you're going to keep for the rest of your life. So again, credit cards are an incredible tool for your credit toolbox. We don't want to take a hammer, use it, and leave it out in the lawn, okay? We want to take that hammer, use it, put it right back in your toolbox. On your credit cards, open them, use them, pay them on time all the time. Keep your balances below 30%, and 15% is how long you keep them, so never close them. Hope this helps, folks. Look to talk to you about our next element of credit very soon.